Most people look at markets like they're watching a storm. They see the lightning, they hear the thunder, and they react to it. But few understand what causes the storm in the first place. What drives markets? What truly moves prices is not noise, it's not luck. It's a timeless dance between supply and demand. And if you can understand that, really internalize it, you stop reacting to the weather and you start predicting the climate. Most people see markets as chaotic, up one day, down the next, with headlines offering endless explanations after the fact. But what they fail to understand is that markets are not random, they are machines, governed by principles, relationships, and feedback loops that are as real as gravity. Every price movement, every swing, every rally or collapse, these are not coincidences. They are outcomes of cause and effect relation. If you don't understand those relationships, you are not just uninformed, you're vulnerable. Everything in the market happens for a reason. And that reason, more often than not, is a shift in supply and demand. These shifts don't happen in a vacuum. They are caused by real-world events, changes in interest rates, shifts in sentiment, policy decisions, technological innovations, political instability, and most importantly, the decisions and reactions of market participants themselves. The market is a reflection of people reacting to changing circumstances, and those reactions create feedback loops, positive and negative, that either reinforce or counteract what came before. Think of the market as a collection of transactions. Every buyer has a reason to buy. Every seller has a reason to sell. Those reasons are rooted in beliefs about what something is worth, what it will be worth in the future, and what risk they're willing to take to be right. When those beliefs align, for instance, when many people believe a stock is undervalued, demand increases. When demand outpaces supply, prices rise, not because of magic, but because of math. When the opposite happens, when more people want to exit than enter, prices fall. It's not emotional, it's logical. But here's where it gets deeper. Most people react to prices rather than understand what's causing them. They see price go up and they assume it will keep going up. They see price go down and they panic. But the smart investor, the thoughtful trader, steps back and asks, what is the cause? Is it sustainable? Is it driven by fundamentals or just a temporary imbalance? Is this a long-term shift in supply or a short-term burst of demand fueled by news? The difference between those who succeed in markets and those who don't is the ability to think in this structured cause and effect way. When you understand how one variable affects another, you stop being surprised by outcomes. You start anticipating them, and you become more resilient, less shaken by volatility, less tempted by euphoria. Markets are ecosystems. Every action has a reaction. When central banks lower interest rates, borrowing becomes cheaper, liquidity increases, and risk assets typically rise. That's cause and effect. When a war breaks out in an oil-producing region, supply constricts and oil prices jump, cause and effect. When a company misses earnings and investors lose faith, demand for its stock drops and so does the price. None of this is random. It's mechanical. You can't navigate the market by watching price alone. That's like trying to understand a movie by looking at still frames. You need to know the sequence, the flow of events that led to this point, and what's likely to come next. You need to understand not just what happened, but why it happened. And that means studying behavior, studying incentives, studying history. Because while circumstances change, human nature doesn't. The best traders are not the ones with the flashiest tools or the most complicated models. They are the ones who have developed an intuitive grasp of cause and effect. They understand that every market movement is telling a story, and they've trained themselves to listen carefully, not reactively, but analytically, not emotionally, but rationally. When you internalize this mindset, you realize you don't need to predict the future. You need to understand how people respond to change, how they respond to fear and greed, how supply and demand are shaped by perception, by incentives, by conditions. And once you understand that, the market becomes less of a mystery and more of a system, one you can work with, not be at the mercy of. So if you're going to survive and thrive in this game, you have to go deeper. Look past the surface, question the narrative, seek the mechanism. Because once you do, you'll stop reacting to the market and start understanding it. And that changes everything. Most people enter markets thinking they need to predict what will happen next. They ask, will the price go up or down? And then they build strategies around those guesses. But markets don't reward guesses. They reward understanding. They reward preparation. The mistake is in thinking the goal is to know what comes next, rather than to understand how people behave under certain conditions and what those behaviors lead to. Prediction is seductive. It gives the illusion of control, but in truth, the future is unknowable in precise terms. You can't consistently predict outcomes because markets are driven by countless variables. Economic data, geopolitical shocks, natural disasters, central bank policies, technological disruptions. Trying to forecast exactly how all of these will play out is like trying to predict the weather a month in advance. You might get lucky once, but you won't build a repeatable process around it. What you can do is understand behavior, how people are likely to act when they are under pressure, when they feel fear, when they get greedy, when they're uncertain. That is something you can observe, study, and prepare for. Because while specific events may be unpredictable, how people react to those events follows consistent patterns. When prices rise quickly, people get excited and tend to pile in late. When prices fall sharply, they panic and sell at the bottom. These aren't random occurrences. They are behavioral responses, deeply wired, time-tested, and recurring. Markets are reflections of human nature. They are made up of people making decisions under uncertainty. So rather than try to predict events, focus on understanding incentives. Ask, what are people likely to do in this scenario? What is the consensus thinking? Where might the consensus be wrong? Because when you find those disconnects between perception and reality, you find opportunity. Behavior is more stable than events. Human tendencies, herding, loss aversion, overconfidence, fear of missing out, don't change. And because they don't change, you can build a framework around them. You can structure your trading to take advantage of irrational responses rather than getting caught up in them. That's a difference between reacting emotionally and acting strategically. A good example of this is in supply and demand zones. These areas on a chart are not magical. They exist because of behavior. A supply zone forms where many people sold in the past and are likely to sell again. A demand zone forms where many bought or missed their entry and are waiting for another chance. These zones are behavioral footprints. They show where participants have made decisions in the past and where they are likely to act again. This is why understanding behavior is more powerful than prediction. You don't need to know exactly what will happen next. You just need to know how participants are likely to behave if price reaches certain areas. That allows you to prepare, not react. Preparation means setting up scenarios, knowing your risk, and positioning yourself in a way where if behavior repeats, you benefit, and if it doesn't, you limit your loss. That's robustness. The key is to think probabilistically, not deterministically. Don't try to be right. Try to be aligned with what's most likely. And always account for the fact that you could be wrong. The most dangerous traders are the ones who are convinced they know. The most successful ones are the ones who remain humble in the face of uncertainty, but confident in their process. When you make your strategy behavior driven, it becomes adaptive. It evolves as market participants evolve. It doesn't rely on being lucky or catching a perfect move. It's grounded in how markets actually work through the actions of people responding to incentives, reacting to pain, chasing pleasure, avoiding uncertainty. This perspective also brings emotional clarity. If you understand that fear and greed are natural parts of the market, then you stop being shocked when they appear. You begin to expect them, and you use them to your advantage instead of letting them control you. That's what separates professionals from amateurs, not that they feel less emotion, but that they built systems to manage it. Be tempting, but it's a trap. Focus on behavior. Observe how people act under pressure. Study how crowds respond at extremes. Build your process around those patterns. That's where consistency comes from. That's where real understanding begins. And in the long run, understanding behavior will always outperform guessing. In life, and especially in markets, everything works as part of a system. Systems are built on structures, and structures are governed by principles. If you don't understand the structure you're operating in or the principles that drive it, you will be lost, reacting to symptoms rather than understanding causes. In the markets, that's a recipe for destruction. To trade successfully, to invest wisely, you have to start with a foundation that is rooted in reality. And reality operates by rules, whether you understand them or not. Markets have a structure. They are not chaotic, even if they sometimes appear that way. They move in cycles. They are shaped by patterns of behavior, reactions to economic conditions, flows of capital, and shifts in sentiment. These forces are not random. They follow principles. And if you can see the structure and grasp the principles, you're in a position to navigate through the noise. Most traders start with tools, indicators, strategies, setups. But tools without understanding are dangerous. You wouldn't try to fly a plane just because you know how to turn the dials. It's the same in markets. If you don't understand the underlying mechanism, then every signal is just noise. Structure provides the framework to interpret what's happening, and principles give you the guideposts for making decisions. Let's take supply and demand as an example. These are not abstract ideas. They are the building blocks of every market move. When price enters a supply zone, it's not magic that causes it to reverse. It's structure. That zone exists because there are unfilled orders there, people waiting to sell, memories of prior decisions that are still affecting behavior. Likewise, demand zones form where buying pressure remains unfinished, or where psychological anchors influence future behavior. These zones persist because of how humans act under conditions of uncertainty. That's structural. Now look deeper. The reason these structures form repeatedly is because the principles that drive them don't change. People still feel fear when prices drop. They still chase gains when prices rise. They still act in herds. These principles of human nature shape the markets just as much as interest rates or earnings reports. If you ignore these principles, you may occasionally win, but your results will be inconsistent and ultimately unsustainable. In this game, consistency only comes from clarity, and clarity only comes from having a framework, something that's not based on opinion or gut feelings, but on timeless truths. When you build your strategy around principles like risk management, liquidity flows, behavioral tendencies, and macroeconomic cause and effect, you begin to see the same patterns everywhere, not because you're forcing them, but because they're there. The structure reveals itself when you know what to look for. The mistake most traders make is that they treat each market situation as unique, but it's not. The conditions may differ, but the underlying principles are the same. Booms and busts, rallies and corrections, these are all just different expressions of the same forces playing out in different ways. That's why history rhymes. That's why you can study past crises and learn how future ones may unfold, not in exact detail, but in essence. Every structure also allows you to be objective. When you operate based on a set of principles, you remove ego from the equation. You stop trying to be right and you start trying to understand. That mindset shift is powerful. Because when you accept that the market isn't personal, that it doesn't care about your opinion, you can approach it with the humility and clarity required to succeed over the long term. This doesn't mean you can predict every move. It means you're not surprised when something happens because you understand how the pieces fit together. You can anticipate where pressure will build, where liquidity will shift, where emotion will override logic. And that gives you an edge, not because you know the future, but because you understand the structure that leads to it. In markets, as in life, structure without principles is fragile. Principles without structure are vague, but when you combine both, when you build your strategy on a well-defined structure and reinforce it with timeless principles, you create something resilient, something that doesn't just survive volatility, but uses it as an advantage. The truth is, the more grounded you are in structure and principles, the less you chase and the more you wait. The less you react, the more you respond. That's where strength comes from. Not from emotion, not from prediction, but from understanding how the system works and operating within it wisely. That's what turns chaos into clarity. In markets, rigidity is a liability. The moment you lock yourself into a fixed way of thinking or a single strategy, you set yourself up for failure. The market is not static. It changes constantly. New information enters, players adapt, conditions evolve, and if you're not evolving with them, you're falling behind. What worked yesterday may not work today, and what works today may become dangerous tomorrow. This is not a flaw in the system, it's the nature of it. The reality is, no strategy works forever. Every approach has a time when it shines and a time when it struggles. Market dynamics shift with interest rates, with geopolitical tensions, with shifts in liquidity, sentiment, technology, and regulation. You can control those changes, but you can control how you respond to them. And your ability to adapt, to update your views, to question your assumptions, to shift your tactics is what separates durability from fragility. This doesn't mean abandoning your principles. It means applying them flexibly. It means understanding the underlying reasons why something works and recognizing when those reasons are no longer present. It means building a process that evolves, not one that calcifies. If your strategy is based on rigid rules that can't tolerate change, then it's only a matter of time before the environment renders it obsolete. Think about the trader who becomes emotionally attached to a setup, who refuses to change course when the market shifts. That trader becomes a prisoner of their own past success. They're not trading the market, they're trading their memory of it. And when the memory stops matching reality, losses accumulate. Not because they didn't know what they were doing once, but because they didn't know how to stop doing it. Adaptability is not about guessing what will happen next. It's about staying in sync with what is happening. That requires awareness, observation, feedback. You try something, you see what the market gives you, and you adjust. That's how learning works. That's how progress happens. It's not linear, it's recursive. You refine, you iterate, you evolve. Markets are adaptive systems. They respond to participants, and participants respond to the market. It's a loop. And like any living system, it's shaped by feedback. If you ignore the feedback, you're ignoring reality. If you listen to it and you respond with humility and clarity, you gain strength, not from being the smartest person in the room, but from being the most open-minded. Open-mindedness is key. You have to be willing to look at conflicting evidence and consider that your current view might be wrong, that your strategy might need refinement, that your assumptions might no longer be valid. Most people don't do this. They fight reality. They defend their ego. But in markets, that's dangerous. The market doesn't care what you think. It doesn't reward stubbornness. It rewards alignment. And alignment only comes through adaptability. You align by observing where the pressure is building, where the energy is shifting, where the crowd is moving, and understanding why. When you can do that without bias, without clinging to your preferences, you put yourself in a position to act from clarity rather than emotion. It's important to distinguish between conviction and stubbornness. Conviction is rooted in understanding. It can adjust when new information emerges. Stubbornness resists change out of pride or fear. One is powerful, the other is fragile. You need to know when to hold your ground and when to let go. That's not a talent, it's a discipline. One that comes from paying attention to reality and responding to it honestly. Adaptability also requires letting go of the need to be right. You're going to be wrong, often, but that's not a problem if you're willing to learn. The real danger is being wrong and staying wrong. And the only way to avoid that is to build a process that encourages regular reflection, honest review, and incremental improvement. If you're constantly learning, constantly updating your understanding, then every mistake becomes a step forward. Every misstep becomes data. You start to develop a deeper sensitivity to the market signals, not because you've cracked some code, but because you've trained yourself to see clearly. In the long run, adaptability outperforms precision. It's not about perfect timing. It's about durable alignment, about surviving the storms, adjusting the sails, and continuing to move forward. The traders and investors who last are the ones who evolve, who refine, who embrace uncertainty, not as a threat, but as a constant teacher. Rigidity breaks, adaptability bends and survives. That's the difference between lasting success and temporary luck. And in a world that never stops changing, it's the only strategy that truly compounds. Most people run from pain. They see it as something to avoid, something that shouldn't be part of the process. But in reality, pain is not the enemy, it's a signal. It's the market's way of telling you that something is wrong, that something in your process, in your thinking, or in your execution isn't aligned with reality. And if you're willing to listen to that signal, to truly engage with it rather than deny or avoid it, it becomes the most powerful tool for growth. Pain alone doesn't create progress. What creates progress is what you do with that pain. It's reflection that turns pain into insight. That moment when you stop and ask, why did this happen? What did I miss? What was I blind to? What part of my thinking was flawed? If you approach that process with honesty and humility, you start to see things more clearly. You uncover blind spots, you identify weaknesses, and from there you can improve. Not emotionally, logically, systematically. The mistake most people make is that they interpret failure as a reflection of their self-worth. So they avoid it, they rationalize it, they blame external factors. But in doing that, they forfeit the lesson, they miss the opportunity. In the markets, those opportunities are costly to ignore because the market doesn't care about how you feel. It only responds to how well you understand it and how effectively you adapt. Every losing trade, every drawdown, every missed opportunity, these are moments that hold data. But that data is only useful if you examine it. You can't improve by glossing over the details. You improve by going into the pain, not away from it. By dissecting what happened, not just emotionally, but structurally. Was it a mistake in analysis and execution and risk management? Or is it a one-off or part of a pattern? The answers are there, but only if you're willing to look. You won't find a single great trader or investor who hasn't taken significant losses. What sets them apart is not that they avoided pain, it's that they used it. They developed a feedback loop. They didn't just record outcomes, they recorded the reasoning that led to those outcomes. And over time, they refined that reasoning, they made it sharper, clearer, more aligned with how reality actually works. That's how progress happens, not in big breakthroughs, but in small, repeated adjustments. And those adjustments come from reflecting on what the pain is telling you. It's a process of constant self-inquiry. What don't I know? What am I assuming? What am I missing? That's not weakness, that's strength. The willingness to challenge your own thinking is what leads to evolution. The people who don't reflect, who just push forward and hope it works next time, they stay stuck. They repeat the same errors, maybe in different forms, but with the same underlying flaw. That flaw compounds until it becomes a breaking point. Reflection interrupts that cycle. It turns randomness into pattern, reaction into understanding. This applies not just to trading, but to every decision-making process. Pain reveals reality. And the more you embrace that reality, the more your decisions start to align with it. You stop operating on illusions. You start making emotional decisions. You start building a system that incorporates feedback, that evolves with each lesson. There's also a deeper layer to this. When you reflect honestly, you build confidence, not the shallow kind that comes from being right once or twice, but the durable kind that comes from knowing you can handle being wrong and grow from it. That kind of confidence is unshakable because it's rooted in truth, not hope. You also start to build a kind of emotional muscle. The pain doesn't hit as hard because you've trained yourself to see it differently. You stop fearing it and you start seeking the lesson inside it. That shift, seeing pain not as a failure, but as a teacher, is transformative. It makes you resilient. It makes you adaptable. And most importantly, it makes you honest with yourself and with the market. No one escapes pain. The question is whether you'll let it refine you or define you. Whether you'll run from it or use it, the choice is always there. And if you choose to reflect, to truly look at yourself and your process through the lens of what reality is trying to teach you, then every painful moment becomes an investment in your own evolution. In the end, progress is not about being perfect. It's about being willing to improve. And the road to improvement is paved with moments of discomfort, with failure, with error. But if you combine that pain with reflection, deliberate, honest, thoughtful reflection, you create something incredibly powerful, a feedback loop that compounds into growth. And that growth over time becomes your greatest edge. So ask yourself, are you chasing price or are you understanding value? Are you following the herd or are you studying the mechanism? Because in the end, trading is not about prediction, it's about preparation.